Every morning, the team at the exchange meets to talk over the top stories of the day. Here's a look behind closed doors at what we think makes the cut. It's no secret Yahoo CEO is trying to turn the company around. If you ask her, she's right on track. Yahoo reported $6.8 billion in profit in third quarter. $6.3 billion of that, well, that's from its stake in the blockbuster Alibaba IPO. A big focus for Meyer has been mobile, which she says is paying off. One activist investor doesn't agree with her plans. Starboard Value says Yahoo's wasting too much money buying smaller companies and that she mismanaged the Alibaba stake. Starboard also points out a major value gap, saying Yahoo's remaining stake in Alibaba is currently worth more than the entire enterprise value of Yahoo. In a presentation yesterday, Meyer defended her strategy.
We've come really far, really fast. We have built a truly excellent team that is up to the task. That team, our board, and I have and will continue to be careful stewards of shareholders' money. This team has now been in place for 2 years, and we've achieved much more than many people realize. We have delivered significant shareholder value.
Which had us wondering what she sees that others don't.
Sounds like she's saying it's undervalued, right? That's investor speak for like, we're worth more, eventually the market's going to realize it.
She had nothing to do with Alibaba. That stake in Alibaba is, 9 years old or something, so it's not like she can claim success there.
Well, she did. She said that she calmed the situation. There was some attitude from either side or something like that, and so she calmed things down.
If you took out Yahoo's stake in Alibaba, the Yahoo shares should actually be worth like negative money.
Yes.
I still like Yahoo.
You like paying them for your email every month?
That's my original email.
Oh wait, you actually pay them for it? Money. Real money.
Sorry.
The founder of Facebook made a splash in China despite the fact that no one on the mainland can actually access his site. Mark Zuckerberg spoke in Beijing answering questions in novice Mandarin to the delight of the crowd. He talked about innovation and connecting Chinese companies to the rest of the world through ads. He didn't mention whether Facebook would be available to Chinese users in the future. The site has been blocked since 2009, along with most major social media sites. His lawyer, meanwhile, is hard at work back in the U.S. Zuckerberg is suing a law firm there for representing a man who sued him. He says the law firm should have known the 2010 lawsuit brought by their client, Paul Siglia, was a fraud. The judge who presided over the case threw it out because it was based on forged documents. In a meeting this morning, we had differing opinions on the critical eye lawyers should have to take in deciding to take on a civil case. We had a long discussion about this. Here's just a taste. Not only not settling, but he's going to the lawyers and saying, you are accountable for this.
Well, because people just keep suing him and suing him and suing him, and he wants to put an end to it.
Brilliant argument he's making, which I think is so valid, is when a super credible law firm takes on a case, they're giving it credibility.
So what? I mean, why is it the lawyer's job to decide that that has merit or not? That's what the courts are for.
It is the lawyer's job to vet things and say, does this have any merit? Does this firm at Piper just saw an easy billing and I think probably expected Zuckerberg to settle? A British grocery giant is trying to clean up a major accounting mess. Last month, Tesco warned it had overstated its profit. Today, it revealed the error was bigger than it first thought and that these irregularities in its books stretch back 2 years. Richard Broadbent, as chair of Tesco's board, says he'll step down and made this statement. The issues that have come to light over recent weeks are a matter of profound regret. We've acted quickly to clarify the financial performance of the company. A new management team is in place to address the root causes of the misstatement. Meanwhile, legendary investor Warren Buffett had a 5% stake in Tesco. In a recent interview, he said that was a huge mistake. He's reduced that position now to 3%. It comes at a time when other investments of Buffett's aren't really panning out very well. It's earnings season, and some of the major companies his Berkshire Hathaway portfolio holds are definitely disappointing investors. As of June, Berkshire was Coca-Cola's biggest shareholder. Well, after a tough quarter, Coke's stock has fizzled, reducing the value of Berkshire's 9% stake by more than $1 billion. Over at IBM, well, that stock fell to a 3-year low after it said it will miss profit targets next year. That had Berkshire losing another billion because of its 7% stake in the company. Other holdings that have slumped lately include Wells Fargo, American Express, ExxonMobil, Suncor Energy, and GM. Over the last few days, the Oracle of Omaha has lost billions. It made us question if his strategy may be out of date.
So Buffett's made a career about being the world's best investor by buying and hold. And in the last little while, that hasn't worked anymore.
His whole thing has been, buy the blue chips that you understand and hold them for a long time. Well, maybe it turns out Coke is Wayne Computer. Remember Wayne Computer?
Wow.
I don't remember Wayne Computer.
You're too young to remember Wayne Computer. You were still in grade school. But it was one of the nifty 50s. You thought it was going to be around forever. And that's what happens, right? And the cycle of companies disappearing off the S&P 500 is speeding up. So the whole Buffett thesis of buy and hold starts to crater a little bit. Even if it is showing signs of weakness, Warren Buffett's investing strategy is coming off a rather long track record of success. So do these latest blue chip losses mean it's starting to change or need to? Lawrence Cunningham is a scholar of Warren Buffett and author of a new book, Berkshire Beyond Buffett, The Enduring Value of Values. Great to have you with us. I want to start with what we're seeing here, which is he has had this, the Buffett way, this very clear idea about how to buy something, why to buy something, and not to really mess with it. He's a long-term investor. He's stated that's the case. Does it come a point when even a long-term investor needs to say, you know what, people aren't going to drink Coke forever. Maybe it's time to sell this position?
If the economic characteristics of a business deteriorate, then a value investor will decide to sell. I just stress here in the case of Coca-Cola and IBM and even American Express and Wells Fargo is the other that you mentioned, what people are observing is a decline in price and not necessarily a deterioration in the underlying fundamentals. So that's, value investing, number one, insists to recognize that there's a big difference between price and value. So just because you have a $1 billion decline in the price of Coca-Cola doesn't mean the value has changed.
No,
so that's a very important distinction.
Absolutely, and in fact, a value investor might load up on the stock. In this case, though, Coke is saying, its sales are falling. It's seeing declining sales right across the board, and the question you'd ask is there a kind of a structural change in how people will consume its product? IBM has had 10 quarters of declining sales, so at some point you sort of say, maybe even the value investor needs to take a look at these fundamentals and say it's time to change. From what you know of Warren Buffett and what you've observed, is that on the table for him? Can he look at his old stalwarts and easily say, I'm going to get out of this now?
I mean, absolutely. Berkshire's portfolio, his favorite holding period is forever, but with common stocks, they're not part of Berkshire's culture. They're not part of its institution. That's a portfolio, and when the economic characteristics of those companies deteriorate, they're sold. Berkshire has sold a lot of companies over the years. Walt Disney, Exxon, it's bought and sold, Freddie Mac, McDonald's. So the Coca-Cola position, I just want to emphasize, has been held since 1988 or 89. Berkshire is still up 10 or 11 times on that position. So I think it's a little too soon, and certainly a couple quarters of question don't warrant an immediate change. But if the economic characteristics deteriorate, it will be sold. On IBM, I just stressed that when Berkshire bought it in 2011, Buffett forecast that the stock price would swoon. And he said he'd prefer that. So at least on the surface, this is something to cheer at Berkshire, not to lament. In fact, one reason for that is that IBM is a big repurchaser of its shares, and the more it repurchases, the larger Berkshire's percentage ownership is. So, but again, if the economic characteristics deteriorate, Berkshire will sell those not the wholly owned subsidiaries, but these stock positions, because they're not part of Berkshire's fabric or culture. They're just investments.
So let's get to the heart of what you were writing about, which is the culture. It's obviously very centered on Warren Buffett. What does happen to Berkshire beyond Buffett? A lot of investors will want to know because they, as you say, they've made a lot of money. What happens next?
Well, the media consensus seems to be that Buffett and Berkshire are synonymous, so that as Warren goes, so Berkshire goes. And that concerned me and probably a lot of other Berkshire shareholders because even though he may live to 120 or 110, he is 84 years old. And so I researched that question by examining all of the wholly owned subsidiaries. And I did that because many people misconceive Berkshire. They think of it as Warren's investment portfolio as a kind of a mutual fund, when in fact that's an out-of-date description. That might have been true in the 90s, but today most of the value in Berkshire Hathaway is in its wholly owned operating subsidiaries. So that's the business that really matters. The stock is a far less significant component of Berkshire than it used to be. So my book examines all of these wholly owned businesses, 50 of them, and tries to figure out what they have in common. And I identify 9 values, including permanence and a sense of autonomy, that I contend in the book constitutes a corporate culture that is larger than any single man. And I contend that Warren's single most important achievement, more than vast fortune and generous philanthropy, is building an institution that's larger than himself.
All right, Lawrence, great to have you with us today.
Thanks, Amanda.
Lawrence Cunningham is author of Berkshire Beyond Buffett, The Enduring Value of Values.